Welcome back to a new weekly outlook. This week is not about chasing headlines or guessing CPI data because the markets are repricing something far more important, and that is confidence in institutions, in policy credibility, and overall in the global stability. That's why when the market opened up today, we saw that the US dollar was weakening. We saw gold and silver pressing record highs. We saw oil holding a geopolitical risk premium and the equity markets remaining calm on the surface but fragile underneath. So in this outlook, I'll break down what the institutions are actually reacting to, how that translates into the risk on or risk off market behavior, and how us retail traders should prepare across indices, Forex, gold, silver, and oil using pure price action on the technical analysis side. So let's start off with some macro fundamentals first. The first article here talks about the most important development this weekend, which is the Federal Reserve now facing grand jury subpoenas from the U.S. Justice Department tied to Chair Jerome Powell's prior testimony. And Powell himself has framed this as part of a broader political pressure around the interest rate decisions from the current administration. So when this news came out, the markets immediately translated that into a credibility risk premium onto the US dollar. And usually when investors will start questioning whether monetary policy is insulated from political pressure, we will see that the global capital is not going to wait for confirmation. Instead, it's going to reprice risk immediately. So that's why we can clearly see that the Bloomberg Dollar Spot Index fell the most in nearly 3 weeks now. The Treasury futures caught a bid, gold and silver surged, we saw the equity futures softening and safe haven assets like the Swiss franc strengthening. So this is not a normal rate expectations week for US dollar. Rather, this is more like a policy trust week. And then going on to the next article, we are looking at the bond market, where we see that the bond market is doing what it always does during regime transitions, and that is that it's expressing uncertainty through the curve. We see that the recent US jobs data came in softer than expected, which keeps expectations for future rate cuts alive while inflation remains sticky enough to prevent any immediate easing. So that is helping us understand what type of interest rate decisions we will be seeing going into the end of January, which is for the most part, probably we're going to see that the interest rates are going to be maintained, no cut, and no obviously hikes. So that tug of war has now revived the curve steepener trade, which is one of the most popular institutional positions going into 2026, where we see the front end yields price potential easing later this year. And then we also have the long end yields remain pressured by supply, deficits, and risk premium. What does that all mean for us retail traders? That volatility will stay elevated, headline sensitivity increases, and markets will respect the technical structure more than the narratives. Then moving on to the equities. So if you're trading US 30, NAS 100, S&P 500, any of those, this is going to be important for us because we see that the dominance of the M7 is cracking. Now, this does not mean that the equities are about to crash. What the institutions are instead doing, according to the article, is rotating away from crowded mega cap leadership, repricing earnings risk, and becoming more selective with the risk exposure. That's why indices can remain elevated while the intraday volatility increases and the leadership becomes narrower and less forgiving. So that would create a fragile calm, but not a risk-off panic. And then continuing on to some geopolitical news. Iran is facing the most significant internal unrest since 2022, and the markets are treating this as non-trivial. What that basically means is that the risk here is not the sentiment, it's mostly the supply disruption, especially with the oil markets, because Iran exports nearly 2 million barrels per day, and any disruption would materially impact the oil markets. That's why oil has held its biggest two-day gain since October, and options markets are showing a sharp skew towards the upside protection. The important distinction to note here is that geopolitical risk is priced very quickly, but only sustained if the supply is actually disrupted. So that's why oil is bid, but it still requires some price confirmation. So we're expecting some knee-jerk reactions here, but we're not really expecting continuation of those movements. That's why we need to be very careful with this volatility here. And then we have under the radar but critical development here. The US is hosting a G7 meeting focused on rare earths and critical minerals as China tightens controls amid the geopolitical tensions that we have been seeing all across the board. Why does that matter? Why do we care as traders? Because China dominates the rare earth supply chains, and these materials are essential for EVs, defense, and technology sectors. Supply constraints feed directly into industrial inflation and strategic competition. So this is not just a 1 week story. This is going to be more like a 2026 structural macro theme that we are going to be following. Another interesting article that I wanted to go over today was that at the same time as we see all these geopolitical tensions happening and everything with the equities market, the optimism towards the Chinese currencies increasing. The hedging costs against US dollar losses have fallen to multi-year lows. Corporates are increasing Forex forward and options activity, and banks are selling dollars in spot markets to hedge the exposure. So this further reinforces the broader US dollar weakness and supports commodities, Asian risk stability, and the non-US dollar Forex strength. What I do want to clear up here is a few dangerous misconceptions that I have been seeing from the retail side. The first one is that gold is up because CPI will be bad. That's wrong. It's not true because gold is pricing institutional trust risk plus the geopolitics. The second one that I've been hearing is that the US dollar is just pulling back before the next rally. Also not true because this is not going to happen when policy credibility is being questioned. The third one is that oil spikes always mean a trend change. That is only true if the structure will confirm it, which it is not at the moment. And the final one that I've been hearing is that stocks are fine because the S&P is near highs. Again, surface calm does not equal underlying stability. So if you trade this week emotionally, then you will absolutely get chopped in the markets. Again, I will be sending out my market notes through my free newsletter. So if you guys want to sign up for that, I have the link for that below. But let's go ahead and move on to the economic calendar and take a look at the data that we will be trading this week. We start off quite easy. We have a JPY bank holiday in the first Asian session. So very easy session in terms of economic data, but of course the market is pricing in all the macro fundamentals that have come out over the weekend. Monday is quite easy as well, but I do expect the New York session to be a little bit more volatile because of, again, the macro fundamentals, especially everything that's happening with the Fed. Then we have CPI data coming out. This is December's data on Tuesday, so we are going to be trading that. And I expect a lot more volatility to kick in around New York Stock Exchange open and about 30 minutes after that. Wednesday, you have PPI data coming out. Same thing. I expect more volatility in the market around New York Stock Exchange open and then 30 minutes after that. And then we also get October's data with that. Continue down, we have GDP data coming out and pre-London session on Wednesday from the UK. So if you're trading the pound, you want to pay attention to that. And then on Thursday, we end off quite easy with unemployment claims, and then Friday, nothing high impact. So we are really going to be following the macro fundamentals this week more than the actual data points besides CPI and PPI. Now let's start off with US 30 here on the weekly time frame. I'm going to mark off the resistance. Last week we tapped into an all-time high. Nice little rejection into 49,600. We are going to adjust that when we drop down to lower time frames. And then I'm going to mark off this resistance right here. Which is 48,700. Let's drop down to the daily. So we see a massive rejection here on Wednesday. If you want, you can adjust it down to 49,500. That is the main level that I want to watch out for, because if price fails to continue back up bullish above that, then we're just going to be sitting in this range right here. That's going to be our trade for the week, just looking for sells to come back down into 48,800, 48,700, and then bounce right back up bullish. So here We still have our higher highs and higher lows on the overall structure. It's still a bullish bias while the daily structure still holds here for any swing trade opportunities. But if we're looking for any scalps, day trades, then this is a range that we're looking at. And then once price pulls back, taps into 48,700, respects it as a support once again, and we have the fundamentals to support the movement, there's a very high chance that we can tap into 50,000 mark. But the main thing here in terms of execution is that for higher time frame structure and for a swing trade opportunity, we are going to be favoring any pullbacks into this higher time frame levels of support, especially around 48,800 or 48,700. We're going to avoid chasing any sort of highs here. And if structure breaks, then we're not going to assume any sort of continuation for a massive sell-off. We're just going to be seeing if price will reverse back down into 48,000 or 47,900 into previous liquidity areas where we've had massive run-ups from previously. And then if price will hold on to a support and then continue pushing back up. I don't really expect or count it as a break of structure unless price can break below 47,000, which is a major level given the price action, especially from higher time frames. And you can check that on the weekly as well. Come down to the 4-hour time frame, perfect rejection. So if we're looking for any continuation sells, again, just trading zone to zone, then we're looking for sells below the zone and a continuation. So after a rejection here, we're looking for sells to come back down into 48,800 or 48,700. Coming to the lower time frames, onto the hourly time frame. We're kind of in the middle of the range, so I'm not really entertaining any sort of trades here just yet. Just a zone to zone trade is going to be the play here. Now coming to GBP USD, let's take a look at the weekly time frame. We have a support. So if I zoom in, you'll see a support formation here, previous resistance, and this is where price has been struggling to break below for the last 2 weeks. And that is that 1.34. My resistance. It seems like this week we've already made a bit of a top wick. And then that's what I'm going to mark off for now. Come on to the daily. What I'm going to be checking here is any sort of consolidation in the past. And if so, there's a very high chance that price will consolidate here as well. But if we can get bullish candle closures here within this range, like today, very high chance that we look for that continuation to the upside. And this ends up just being a retracement, a new higher low formation, and then a continuation right back up. We're going to avoid any sort of impulse trades here. On the 4-hour time frame, that consolidation becomes more clear. So in between here, that's my no trade range. My sells are only valid below 1.34, coming down into this 1.332 area right here, or looking for buys as price breaks above 1.345, coming into about 1.34, let's say 9 or even 1.35, coming back into this consolidation area here. On the hourly time frame, same thing, you're kind of sitting in the middle of the range, so no trade here just yet. Your USD tends to be quite similar in terms of structure. We have a weekly support. And then we have a resistance formation here already, but what I would like to do is really create it right underneath the support and then see how price reacts here in this range from a daily time frame. Come into the daily time frame and I see a lot more consolidation here. I see that price tries to break below that area, consolidates, and then pulls right back into that resistance of 1.17. And then same thing here, price pulls back and then breaks right into that area. So if we get a bullish candle closure here on daily, very high chance that we're headed right back up into 1.17. On the 4-hour, we got a very strong bullish candle closure. So if in London session, we can see that price maintains above this area, those are clean buys to the upside with a stop loss below that zone, targeting around 38 pips or so. But same thing as GBP USD, I like to use my major pairs as swing trades. So what I would like to see is price retracing up into 1.17. Give me a corrective move of some of this bearish pressure here. And then if it's going to continue pushing back down, if we continue seeing that the dollar somehow gains more strength against the euro because of fundamentals, then we might see another sell-off coming right back into the zone. If not, and the dollar weakens, then we're seeing that continuation bullish structure to the upside that we see based off of the weekly time frame here already. Massive bullish momentum, a bit of consolidation that we're sitting in right now. Potentially to come back and tap into that around 1.18 area, which is the resistance of that consolidation on the weekly time frame that we just saw. Now, coming over to GBP JPY, this is more like a high momentum, high risk pair in the current macro conditions. I'm going to zoom out. I'm going to look to the left, because as you can see, really we're coming back and revisiting the highs that we haven't even tapped into since 2008. So here, based off the weekly time frame, there's nothing stopping us until 214.8, which was a previous high, and then a massive sell-off that happened for the remainder of 2008. So that's a massive level that we are still targeting here. When we drop down to lower time frames, we're gonna map out the more intraday levels of how you're really gonna catch those trades up into 214.8. All right, and then we have our support, which is you can do a bottom wick. 211.7. Come onto the daily. That is the consolidation for the daily, or the resistance for the consolidation on the daily time frame. And then a push up. Excuse the mini pauses in between, I'm still recovering from a cold. But we have filled in that entire wick right here. And then if we can continue that bullish momentum to the left, then we have, again, just looking for minor levels here. Really nothing that's going to be stopping us too much. I'm just going to bring that in a little bit more, which is 213.9. So as you can see, there's really nothing stopping us from just continuing back up bullish. It's just that when we drop down to lower time frames, we want to see price holding onto some of these key areas. As it breaks above it, respect it as a new support, and then continue the bullish momentum to the upside. We just want to see that continuation of higher highs and higher low formations here. That's pretty much it. The healthy bullish trend. So only trade this when you have your full confirmation. Like I said, this is a high momentum, high risk pair right now. And when I'm going to be trading this week, my goal is that I'm going to be trading it with a smaller size than usual, because I'm expecting a lot more volatility spikes if the risk sentiment does shift overall from a macro fundamental perspective. This is going to be a key pair for this week. And that is why we're going to be extra careful on this pair too, because USD JPY right now is caught between the US dollar credibility weakness and the yen's safe haven characteristics. So that's why I'm going to be trading this pair as well, but with a little bit less risk. So usually I go in with about 2% risk per trade, but I'm going to be trading with about 1% entry and then scaling after that. When I come onto the daily time frame, I see that is the previous resistance. What I'm going to do is actually adjust this a little bit higher, give myself a pretty good range for this week, right into that wick rejection before that massive sell-off that happened in January 2025. But overall, I do want to watch out for this range right here. So as long as this price can break its own high and continue pushing, we're pretty solid for any buy opportunities for about 64 pips. If price rejects that like it has in the past and it continues pushing back down, another zone, practically anything between this zone and the zone above it is no trade range for me. But if price breaks below that, then I'm looking for sells for it to come back down into the 155 mark. Come on to the 4-hour time frame. Again, no trade zone, even for a scalp. Any scalp or day trades, break and retest below this. Continue pushing down, ultimate target being 156 or even 155. For any buys, I would be targeting around 158.5 and then a 158.9 or even a 159 flat. Now come on to gold. Right. We've got all-time highs. The projection from Goldman Sachs and JP Morgan end of 2025 was that gold was going to be pushing around 4,900 or even 5,000 in 2026. And it seems like it's on track to do that as well. Use that. All right, so overall, from a fundamental perspective, we see the Fed independence risk that's really pushing this, the geopolitics, and then also the lower trust in US dollar that we are seeing. But that doesn't mean that we're going to see a massive gold sell-off from a fundamental perspective. But what is very interesting to see is that we are going to see a bit of a rebalancing happening in terms of the index holdings. So gold and silver will be, we're going to see some corrective moves there happening this week, and that is because both Bloomberg and then even S&P 500 or S&P Global, sorry, their index, they're only allowed to hold a certain amount of gold and silver, and because of the massive rallies that we have seen throughout all of 2025, that number has gone above that threshold. So basically now the institutions, it's not like they've changed their perspective or they've changed their analysis, but they are being forced to sell off some aspects of gold and silver from their portfolios to meet that threshold once again. If you guys want, I can do another full detailed video on that specifically for gold and silver and what are we expecting. So if you want that, just let me know in the comments and I can do that for you guys. But that is one thing that I want you guys to be aware of, that whenever we do see that corrective move happening this week, it's not because that the geopolitical tensions are gone or because there's a fundamental catalyst that's really causing gold or silver to sell off. It's simply because annually we see this rebalancing happening around this time of the year. So then let's go ahead and drop down to the daily time frame. Today we've already tapped into those all-time highs. It seems like we do have a bit of a gap up. And then we have, I'm just going to mark off the previous day's candle close right here. And then I want to see on lower time frames how price is reacting here between 45.10 and then 46.07. So there's the gap up. We definitely want to see that being filled and then a continuation back up. The buys here are still bullish while that structure holds. In terms of execution, we're going to buy any pullbacks into these higher time frame support levels. So whether that's 45.10 and then we see a confirmation of support and then push back up, that's going to be a nice buy. Further sells into, let's say, 44.20 and then a continuation buy But basically, any of these key areas are completely valid as long as we can see support being held. Now come on to the hourly. We saw a massive spike right when the market opened up. In Asian session, we have seen the market already price in the fundamentals. We want to see if there's going to be any volatility at London Open or even New York. And then potentially a gap fill here. But we do have a bigger gap fill from last week that the market has to still come in and fill. Now looking at silver, we don't usually look at silver and oil, but I do want to do a quick analysis on them. And again, like I said, if you guys want a full detailed analysis video on, what's happening with the index and stuff like that, and how that's going to be impacting gold and silver, I'm more than happy to do that. Just let me know if you want that. Now coming onto the daily time frame, major support. And then let's come on to the 4-hour. So this is my overall range for the week. Now for the next session or two, I want to see if price can come back and revisit into this area, fill in some of that gap, hold on to a support. If it holds on to a support, we see an established support here, a correction of some of this bullish momentum, and then a push back up. Then we're looking for those continued buys to the upside. The ultimate target is to see if it can tap into $90. That has been some of the predictions from some of the major hedge funds and even JP Morgan and Bank of America analysts. When we drop down to the 1-hour time frame, we're starting to see some consolidation. So any buys would be after price can show us an established support and then a continuation up. So that necessarily does not have to be just a correction. It could be a consolidation. We see a push, and then the next candle, a bearish candle closure, break and retest above that area and push back up. Ideally, we want to see price pull back down into the 80 mark, give us a gap fill right here, and then continuation back up. But like I said, we do have another catalyst that is at play that's going to be affecting gold and silver this week too. Now looking at oil, we're not really expecting massive movements here on US oil given the fundamentals, but the main thing that's really going to be impacting US oil, or that's really going to push it in terms of major price movement, is if really the supply is being constrained or if there's any disruptions with the supply of oil, especially with Iran's situation. So here, all of that has been priced in already right when the market opened up, but the structural downtrend that we see here is still quite relevant. So we're only going to trade this if the continuation of the movement, if price breaks and holds that structure. But we're going to treat these spikes that are going to happen without any sort of confirmation as just more like a risk premium fade. So with that being said, based off the weekly time frame, we just keep holding on to the same support since 2025, early 2025. And then in terms of resistance, we have same one for the last couple of weeks, which is also 60.5. And if you look to the left, that's a very strong level that price keeps tapping into. And then after that, we'll see some major movements that we want to be a part of. So as of right now, when it comes to oil, we're sitting in a consolidation area. So whenever price does break out of it, I'm expecting more volume, and that's what we want to be trading. When you drop down to the daily time frame, same thing. Bearish structure, kind of testing structure right now. We're even up until 60.5. If price can break above it, hold that new structure and then continue pushing, then we'll look for buy opportunities here. So overall, this week is not for chasing candles or trading every single headline that's going to be coming out or forcing any sort of setups. But what this week is for is structure, confirmation, and having disciplined risk. For some of these pairs, they're going to be a lot more volatile. They're going to be a lot more sensitive to the type of headlines that we are following. So we just want to be more careful in terms of risk management. If you're risking around 2%, then only risk about 1% with your initial entry and then look for your scale and opportunity. You'll just be more conservative in terms of your trade. And if CPI is approaching and you still haven't already positioned cleanly into the market, then just wait until CPI is released and then look for your trade after that. this is going to be one of those weeks where you're just one high quality trade is going to be enough. So you don't really have to chase a lot of trades this week. And it's going to reward your preparation, whereas people who are just going to be taking a lot of impulsive trades are really going to get chalked in the markets. So if this outlook helped you think about the markets more clearly, make sure that you're subscribed. I will post a full institutional style weekly outlook every single week, breaking down fundamentals, market sentiment, and price action. So then you have more clarity starting off the week. And again, I do have a free newsletter where I write down all the market notes, all the major things that you need to know. And I always have free resources as well, such as FX Street articles that I write about different topics. So if you guys want access to that, then I will drop a link right in the description so you guys can sign up for that free newsletter. So it's not spam or anything, just pure market knowledge. And I'll see you guys for the next weekly outlook.